Good morning, everyone, and welcome to Transfer Pricing Update in Kingdom of Saudi Arabia webinar by WTS Druva. So before we start the webinar, let's please agree on some housekeeping rules. Please, if you face any technical difficulties or during this webinar, please post your issue on the chat box so we can manage and fix it for you. The webinar is about 1 hour. So and post the presentation, please. We will have some Q&A. We will have one Q&A session. And during this Q&A session also, if someone have any question in Arabic, also please feel free, and we will also try to answer his query in Arabic. Also, please, if you have any questions, you can type it in the chat box. You can find it on top of the screen. Webinar is recorded and it will be shared subsequently. Let me introduce Kabil and myself. My name is Hani Nagar. I'm an associate partner in WTS Druva, managing Middle East and GCC countries. Mr. Kabil is our associate partner who is a transfer pricing leader, covering also Middle East and GCC. So we have 5 main content today. We will go through it. So we will start our webinar what is the transfer pricing, and we will also cover some case studies. We will focus more on transfer pricing in KSA, especially after the new changes most of us already witnessed in KSA market. We also will cover the advanced pricing agreement, which also newly introduced on the new TB changes in KSA. And we also will highlight some tax implication for taxpayer and Zakat payer. So we can start with what is the transfer pricing, and I will hand it over to Mr. Kabil. He will take us through main transfer pricing interest topics. Please, Kabil.
Thanks, Hani. So before we start, it is very, very important that the new regulations which have just coming, or the new amendment which is coming in the Saudi Arabia, it talks about that transfer pricing regulations will now be applicable to Zakat players also. And many viewers on the webinar would fall under those category. Before we get into the amendments and we understand what are the compliance requirements and what are the tax implications, it is very, very important to understand what exactly transfer pricing means. And we just thought we'll spend few minutes discussing the nuances around transfer pricing, the principles, and certain case studies. Transfer pricing is nothing but a term which implies a mechanism of pricing cross-border inter-firm transactions between related parties and connected persons. It refers typically to setting of prices for transactions of goods, services, intangibles, capital access, etc. Typically, globally, the transfer pricing regulations have been enunciated by an organization called Organization for Economic Cooperation and Development, which is the OECD, and the OECD transfer pricing guidelines are typically followed across the globe. In UAE, while we're discussing KSA, in UAE, the UAE transfer pricing regulations have been adopted and will be released soon in alignment with the OECD guidelines. And similar to that, even the KSA regulations are more or less aligned with the OECD principles. What it entails is that typically, all the transactions between connected persons and related parties ideally should be at market value, or the technical term which is generally used is that all these transactions between two related parties should be done at arm's length price. Why transfer pricing, and why is it such a big, why is it of relevance to the public at large? Typically, we have seen that multinationals charge a higher price when they are interacting with group companies, whenever their transactions are between a high tax jurisdiction and a low tax jurisdiction. Let's take a very simple example. We have Kingdom of Saudi Arabia, where the headline corporate tax rate is 20%. And assuming it has a related party, let's say in Bahrain, which has a 0% tax, or even UAE, which earlier had a 0% tax and now really a 9% headline tax rate. Now, the intent of that multinational enterprise could be to that the transfer prices should be adjusted in a manner that the profits from a Kingdom of Saudi Arabia entity gets shifted from KSA to UAE or to Bahrain in our example. Now, that would really mean that typically the Kingdom of Saudi Arabia would then lose out on the taxes which are due to be paid in that particular jurisdiction. In order to avoid those particular tax avoidance arrangements, transfer pricing regulations have been introduced. Typically, a BEPS program, which was the base erosion and profit shifting program initiated by the OECD, has been adopted, and KSA also is a part of that BEPS initiative. It really means that every taxpayer on whom transfer pricing applies would need to comply not only with justification of arm's length price, but also with maintaining documentation, which is a 3-tier documentation of a local file, master file, and CBCR. And we're going to get into details in terms of what are these compliances and how do they impact from a KSA taxpayer perspective. Typically, we'll just discuss certain case studies in terms of how transfer pricing is applicable on certain transactions and what are the compliance requirements which may emanate from a KSA perspective on such transactions. Let's take an example. We have a related party and we have a KSA group company, and both the entities are engaged into manufacture and distribution of goods and services, and there is a payment being made by the KSA group company to its related party. Similarly, there could be a KSA group company which has purchased goods or availed certain services, and then it is making certain payments to the group companies. What are the TP implications attached to these two transactions? The transactions between the KSA group company and the related party would be subject to transfer pricing provisions, and the payments being made by the KSA group company would need to adhere to the arm's length principle. Also, from a benchmarking or from a justification standpoint, what needs to be done is that the most appropriate method of transfer pricing would need to be determined with respect to these transactions. The group companies would then need to assess what transfer pricing method really justifies the arm's length price, conduct a benchmarking analysis, do a comparable search and determine the comparable margins, determine the profit level indicator, which would really test the arm's length price, and then arrive at the arm's length price and justify the unrelated nature of these transactions. In terms of the compliance requirements, typically these transactions, since they would be covered under the transfer pricing regime, they would need to be disclosed in the TP disclosure form and the TP affidavit. They need to be reported in the local file, which needs to be prepared. If the group meets certain thresholds, then a master file would need to be prepared and maintained for these transactions. And also these transactions would need to be reported in the country by country report, which the multinational group would be preparing. In terms of intergroup financing, and we've seen these kind of transactions happen a lot between group companies, where a related party advances a loan to a KSA group company, and the KSA group company typically pays interest. And these payments of interest could be to entities in low tax jurisdictions. We've also seen in many of our clients, typically a scenario where the KSA group company has been granted a loan which has been further guaranteed by a related party overseas, and the related party guarantees the loan to the bank, and the KSA group company typically pays a guarantee fee to the group company. Now, in terms of these transactions, in terms of intragroup financing, again, these transactions will be subject to the transfer pricing provisions, and they will need to be justified from an arm's length perspective. What needs to be ensured in this particular exercise is that whenever there is a loan being advanced and there is a payment of interest, the interest rate needs to be met from an arm's length perspective. It's not the loan amount, because the loan is the principal. The loan amount would need to be reported, but the actual testing of the arm's length price would really happen from a payment of interest perspective. Similarly, whenever there is a guarantee fee being paid by the KSA group company to the related party, the guarantee fee needs to be ensured that it is at arm's length. Now, when we are doing this kind of benchmarking analysis for intra-group financing, certain points which we need to consider are: what is the duration of the loan? What was the nature of the loan, the purpose, whether it was secured, unsecured, what is the credit rating of the borrower? Because these factors would really determine or will ensure that whenever the entities are doing a benchmarking analysis, the comparables are at par. Again, from a compliance standpoint, these transactions would be reported from a TP disclosure form and in a TP affidavit, and a local file, master file, and a CBCR compliance would need to be done. We've also seen a lot of cases where management fees has been paid by group companies to their related parties. Also, we've seen cases where licensing of IP has happened and a payment of royalty fee has been made by the KSA group company to the related parties. Again, these kind of transactions are subject to transfer pricing provisions under the KSA law, and they need to be made at an arm's length basis. Typically, these kind of payments need to be justified, and specifically from a management fee perspective, the cost base of the services needs to be determined. It needs to be demonstrated that the allocation of cost is true and fair. The cost benefit analysis is conducted, which means that the KSA group company has actually benefited from the receipt of these services from the related party. And these are not shareholder activities, or these are not activities which are not duplicative in nature. And hence, the KSA group company is justified in making these kind of related party payments to its group companies. Typically, when we're talking about licenses and we're talking about royalties, it is very, very important to understand what is the kind of IP being licensed out to the group companies, who is the legal owner and who is the economic owner in the entire supply chain. Typically, who's performing the key functions in terms of developing, enhancement, exploitation, protection, and maintenance of that IP. And typically, the payments on royalty should be factored in, keeping all these aspects. Again, from a compliance standpoint, the TP disclosure form and the TP affidavit needs to report these transactions. Also, these transactions would typically come under the local file, master file, and the CBCR report, which needs to be filed with the KSA authorities. Hani, now I hand it over to you to discuss some of the key aspects of the transfer pricing regulations in KSA and the amendments which have come down.
Okay, thanks, Kabir. It's very interesting one. Yeah, thank you. So let's go for transfer pricing in KSA. KSA is one of the countries part of OECD and G20, inclusive framework on PIPs. ZATCA, which is Zakat and Zakat Tax and Custom Authority, of course, in KSA, is responsible authority for enforcing the TB regulation in KSA. If we look to bylaws itself, we can find in Article 15, it requires a preparation of master file and local file and country by country documentation. Same bylaw in Article 7 and 13 specifically talk about transfer pricing methods and comparable companies. TB or transfer pricing is applicable to transaction, like also Kabir mentioned, involving related person or person under common control. Proof transfer pricing method as per OECD, along with the use of any other methods, it's approved or already accepted by ZATCA. Of course, transfer pricing is applicable to all taxpayers in KSA, and we will cover in other slides as a Kabir now will come into the picture. Yeah, please. There is a very important amendment happened to transfer pricing bylaws in KSA. For the previous TB bylaws, 100% Zakat payers were not subject to transfer pricing provision, only except for CBCR compliance. However, as we witness also, most of us witnessed already, on 7th of April this year, ZATCA announced the issuance of a decision by Board of Directors of ZATCA, which number 8-2-23. The decision approving some changes, which one of these changes will include the payer within the scope of the KSA TB. The applicability of the new changes will be starting from 1st of January 2024, but it will be on two phases as mentioned in this below table. If we can see in front of us the table of applicability. Phase 1 was starting from 1st of January 2024. If we have for related party transaction value less than or equal to 48 million SAR, it will be not applicable. However, more than 48 million, it will be voluntary. More than 100 million, it will be mandatory. This is for starting from 1st of January 2024. Okay, second phase, it will be starting from 1st of January 2027. Same, it will be applicable for less or equal to 48 million. It will not be applicable. However, we can see that for more than 48 million SAR, it will move now from voluntary to be mandatory. And above 100 million, of course, logically, it will come under the mandatory umbrella now, because from 40 million will be mandatory. Of course, above 100 million will be mandatory as well. Okay, so now the payers, they need now to ensure the arm's length nature of their related party transaction and undertake compliance. And I want to highlight something here very important, because maybe if some of audience or one person said, yeah, it will start from 1st of January 2024. So why now we need to highlight this now? No, my answer will be very important, because the transaction or related party transaction, it is not one day transaction. It's not one day changes. So we need to plan very well from now, because we still have time to plan our transaction, to review all the contract. We will go through this one in details in the last slide, but I just want, maybe this question can come to one of the audience here. So I need to answer him. Yes, it's very important to start work on these changes from now. Okay, coming back to our amendment in KSA. The other main amendment or changes in the TB, it will be provision for entering or introducing the ABA, which advanced pricing agreements to both income and tax and Zakat payer. So taxpayer and Zakat payer also, they will have this ABAs on ground now. So one highlight was that Zakat payer whose aggregated value related party transaction is less than or equal to than 40 million, like we highlighted above in the table, will be exempt from the TB documentation requirement in KSA. Okay, let's go a little bit one step back for taxpayer compliance, which was already in place in KSA. So we have main six compliance requirement in KSA: local file, master file, country by country or CBCR, and CBCR notification, and TB disclosure form, and TB affidavit. So if we go for preparation due dates, for local file, master file, it will be within 120 days from physical year end. It depends, of course, on the taxpayer physical year ended when. Is it March or December or June? Country by country, it will be within 12 months from the end of reporting year of M&A. CBCR notification, it will be due filing within 120 days, like the local file and master file. TB disclosure form, which along with the annual tax declaration, will be also within 120 days of the end of the fiscal year. TB affidavit, it will be along with the TB disclosure form within also 120 days. So this is a preparation or due date. If you go for submission due dates, for local file and master file, it will be within 30 days upon requested by ZATCA. Okay. Of course, the taxpayer, he need to specify the annual tax return, whether the TB documentation has to be maintained on the tax declaration itself, and he need to sign and confirm that documentation already in place and already maintained. Okay, please. Yeah. Okay. Let's go for the KPR now, which already covered under the new changes in KSA. Same 6 main compliance requirement will be here, like if you see local file, master file, country by country, reporting and notification, TB disclosure form, TB affidavit. Prior to the amendment, all of them not applicable except for country by country reporting and notification. Let's go see what will happen after these changes. Now we can see all of them start to be yes. So it's all of them now from compliance perspective. It will be required and needed now in KSA. So the KPR now should be compliant with all this requirement. The same of preparation date, due date, and submission date, it will remain the same like taxpayer, which we covered in previous slides, 120 days for both local file and master file. Submission will be 30 days upon requested by ZATCA. And other compliance items, it will be like CBCR within 12 months from end of the reporting year. And notification will be duly filing with 120 days, like we also highlighted for taxpayer. Disclosure form along with the tax declaration or Zakat declaration in this case, and the affidavit of TB along with the TB disclosure within 120 days of the end of the fiscal year. So in summary, after these changes in TB and KSA, the Zakat now he will be subject to all compliance, TB compliance requirement in KSA, starting from 1st of January 2024. Okay, please. Let's have a quick look at ZATCA position regarding transfer pricing audit, especially in KSA. Maybe some of the audience or also from our experience in the KSA market, ZATCA adopts a very aggressive position when it comes to B audits, including they are challenging the TB methods itself used, which the taxpayer using. We will also the taxpayer using later. So ZATCAs usually ask for the TB audit for all related TB documents, including and not limited to master file, local file, benchmark study, agreement in place, basis of calculating the gross charges, invoices, accounting entries, financial data in both records of related parties, budgets and forecast reports by the management reports, management decision even for pricing or changing of policies and the pricing, market studies. So you can see how much data ZATCA is looking for when it comes to audit. In our experience, in many cases, ZATCA audit outcomes have been contradictory to taxpayer TB analysis and documents. Number of cases now, and not a small number, in ZATCA now and under appeal because of result of transfer pricing audit. And from our perspective, from our experience, it's always advisable to prepare all TB documents in an appropriate and detailed manner to support TB position when it comes to ZATCA TB audits. Especially for benchmark studies need to be very, very accurate about the data and the outcome of these studies. Of course, in addition to the document which already mentioned in the second bullet here from ZATCA, which are looking for. Okay, we can move. One of the other changes, very important one, come to effect now in case is advanced pricing agreement, which called ABS, which also we can see in other countries, but in Saudi they are recently introduced, which I handed over to Kabil. He can cover this one in detail. Please, Kabil.
Thanks, Hani. And typically what we've seen, and Hani, you raised a very important topic in terms of the disputes on transfer pricing. And we all know that the ZATCA authorities are looking at these intercompany transactions with a very crucial lens. They look at these intercompany transactions typically to avoid any base erosion from the KSA, jurisdiction. Now, typically, in order to avoid any disputes between a taxpayer and the tax authorities, a mechanism which is known as an advanced pricing mechanism has been introduced, and it is now available to the Zakat payers also, which generally talks about that whenever a Zakat payer or any other taxpayer wants to enter into a transaction and they are uncertain about the transfer pricing or how the authorities are going to look at typically these transfer pricing arrangements, the taxpayers can approach the ZATCA authorities and get an advance ruling. Now, this is something which is not unheard of. It is a concept which is available globally across the globe. Whenever there are double taxation avoidance agreements or treaties being available, there is a specific mechanism or a clause being put in those treaties to opt for an APA. Now, what is an APA? APA typically is a binding arrangement between a taxpayer and the authorities. So it is a binding arrangement. Once it is signed, the authorities as well as the taxpayer cannot back out from that arrangement. It talks about the arm's length price of a future transaction. So typically, like I said in the beginning, that if the taxpayers are uncertain about the pricing arrangement of a transaction and how the authorities are going to look at it in the future, they can enter it into advance and get a certainty. What it really does is that whenever we file an APA with the authorities, the method to determine the arm's length price is brought in or is presented to the authorities in that APA application. It also talks about the validity to which that APA arrangement is going to be valid for. Since it's a binding arrangement, typically the number of years are determined in advance as to when and to how much these APA arrangements are going to be valid for. Some of the benefits of an APA is that it significantly reduces your risk of transfer pricing disputes. Like Hani said, that ZATCA is now looking at many detailed documentation in terms of justification of arm's length price. When we get into an APA arrangement, all these documents are prepared on a real-time basis, submitted to the authorities, discussed with the authorities, and hence we get a much more better face time with the authorities in terms of getting their perspective. And it significantly reduces the transfer pricing disputes because the agreement on a transfer price, on an arm's length price, is agreed beforehand. It provides reasonable certainty to the taxpayer in terms of what is going to be their tax liability for the future years in which the APA is valid for, because the transfer prices or the transaction price with the related party has been fixed, has been agreed with the authorities, and hence to determine the taxability of those transactions becomes very, very certain. It also gives more flexibility in terms of the kind of transfer pricing method which can be used. Hani mentioned that apart from the 5 OECD methods, any other method is something which is also available to the KSA taxpayers in terms of justification of arm's length price. And hence, whenever there is a discussion with the ZATCA authorities across the table in terms of an APA, typically not only a single method, but multiple methods can be used to determine or justify the arm's length price. And it really gives more flexibility in terms of the transfer pricing method to be adopted. It really enhances the transparency because the taxpayer typically shares a lot of information and data in terms of pricing, in terms of intercompany agreements, in terms of backup documentation. And the tax authorities also get a comfort that the transactions which the taxpayer is going to have with the related party are true and fair. And one of the biggest benefits of an APA, and may not be, and we'll discuss it in the ensuing slide in terms of how it mitigates the double taxation. But Typically, when we get into an AP arrangement with the authorities, it significantly reduces the risk of double taxation, because any adjustment or any price which has been adjusted in KSA, in case of a bilateral APA, the other jurisdiction authorities also agree to it, and hence the double taxation risk goes away significantly. Now, there are three types of APA. And we'll discuss the pros and cons of each types of APA. Now, typically a unilateral APA, as the name suggests, is an arrangement between a taxpayer and the jurisdictional tax authority, which would mean that it is an arrangement between the ZATCA authorities as well as the KSA taxpayer. So no overseas related party or overseas jurisdiction tax authority comes into picture. It is a mutually binding arrangement. The agreement, once signed, is binding on both the authorities as well as the taxpayer. Since only two parties are involved and both of them are in the KSA, typically it leads into a faster resolution. So the results are faster. It is less expensive because the amount of statutory fees being paid by the taxpayer would be only to ZATCA and not by the group to all the parties which are being involved. However, one of the disadvantages of a unilateral APA is that the risk of double taxation would still persist. And the reason for that is that this is an arrangement which is binding on the KSA taxpayer and the KSA authorities. An overseas group company sitting in US or UK may not agree to that APA arrangement and may say that whatever transactions have been discussed or the arm's length price has been agreed between KSA is in KSA, and typically the benefit of that will not flow to the US or the UK parent. Now that really comes, as a relief when we enter into a bilateral arrangement. A bilateral arrangement typically is an agreement between the taxpayer, which could be a KSA taxpayer, the KSA related party, the KSA authorities, which is the ZATCA, the overseas related party, and the overseas tax authority. So typically a bilateral APA talks about involvement of all the stakeholders into a particular transaction. Again, this is a mutually binding arrangement. Since the parties are involved are cross-border, it is relatively more time consuming, because in order to fix those meetings between the two different tax authorities of two countries, typically a protocol or a chart or a calendar is drawn up, and they typically meet either once or twice in a year. And that is how typically this process of a bilateral APA may be just more time consuming. And again, not only an APA application needs to be filed in KSA, but a corresponding APA application or a copy of that is also filed by the overseas related party in its jurisdiction, and hence the statutory fees being paid by the group in order to apply for that APA arrangement goes high. However, the risk of double taxation goes down significantly, because the two countries or the two tax authorities sit together, they decide on a price, on the taxability and the transfer price of a particular transaction. And typically it is being agreed that whatever price the KSA entity is going to pay, a corresponding price reflection would happen in the overseas entity's books of accounts. And accordingly, the risk of double taxation goes down significantly. In terms of a multilateral APA, and these are pretty rare in our experience, it really involves multi-jurisdiction taxpayers and multi-jurisdiction related parties. So which would really mean that if a group believes that the transaction involves not only two countries, but more than two countries, then typically a multilateral APA is what is entered into. Again, this is a mutually binding arrangement. And since many countries, many tax authorities and related parties are involved, it is far more time consuming as compared to a unilateral APA or a bilateral APA. And again, the cost of statutory fees being paid by the group per se to the authorities goes up, and the risk of double taxation gets eliminated. This is a very good mechanism or a tool to reduce transfer pricing disputes. We would encourage that taxpayers should opt for these APA programs and on their own approach the authorities in terms of getting a certainty on the transfer price and ensuring that the transfer pricing disputes at a later stage goes down significantly. And Hani will typically in the next section would discuss about the implications and the approach of ZATCA on certain key transactions. Over to you, Hani.
Thanks, Kabir. Okay, let's have a look on the tax implication for taxpayer and Zakat. We listed down here that typical TB transaction in 6 category or 6 items. So if we look on the left side of the table, we can find natural related party transaction. It will be like provision, receipt of services, or purchase or sale of goods, license of IP, trademark, trade name, logo, brand, intragroup financing, like also Kabir highlighted in the beginning of the webinar, and management fees. All of these tax transactions, all of these transactions, it will be subject to transfer pricing guidelines or rules. Will be also subject to VAT, will be subject also to corporate tax and Zakat starting from January 2024, will be subject also to withholding tax. So what will happen? We always advise that not because of TB only you can ignore the other main 3 tax implication like corporate tax or Zakat and VAT and withholding tax. If we take one of the examples that if you have a financing or a loan, you are paying interest. Yes, it will be subject to B guidelines or rules, but it will be subject also to withholding tax. We need also to investigate and see it will be subject to VAT or not. Is it locally provided or domestically or from outside the country it is loan provided? We'll go for withholding tax. Local regulation will subject such interest 15%. There is a tax treaty can be subject to 10%. So we need also to look at the tax treaty between these 2 countries. So we are not saying that because of transfer pricing you need to change something, and on the other one you can be hit it again on the other category or other item on the ground like VAT or withholding tax or corporate tax. So it's a full cycle of evaluation. When you start to evaluate your position or your transaction or your agreement or your contract, whatever, so you need also to consider all other tax aspects from KSA regulation and in addition from ZATCA practice itself. So you can minimize the risk as much as you can. And you will have a proper and you furnish yourself from documentation side when it comes to ZATCA audits. So you can have the comfort that, yeah, all of these angles already covered when I did my assessment or my planning or tax planning or TB implementation, that I am sure now or have a comfort that I will not be impacted. It's not be impacted with other tax aspects. Yes, please. So the way forward now. First, we need to identify the related party and connected persons. Okay. Then the second one, we need to review and update transfer pricing policies and arrangements. And it will be also for both, even for taxpayer, which we already have, reviewing again, and especially if he didn't face an audit from ZATCA or he's under audit, or he already audited and there is some risk highlighted by ZATCA, he needs also to re-review again and update that TB policies and arrangement. But for Zakat, it will be a new exercise he needs to do now. So, and then we can go for plan for phase-wise implementation, which we highlight in the table between 48 million, about 40 million, 100 million. And then we need to also update our IT system to reflect the related parties transaction and what is the position we are taking. Okay. And please. And we use a template to proactively create the documentation, master file, and local file. And the last one, identify benchmarking requirements, and we do or have a proper benchmark in place, which we will use in our either preparing the local file or we provide to ZATCA when it comes to audits or any discussion or queries raised by ZATCA in KSA. These have been pillars that we can propose to way forward. And again, please let me emphasize that when you have a proper TB policy, documentation, benchmark, agreement, process, accounting treatment, financials, supporting your position, it will be more simple when it comes to ZATCA discussions or audit, because as we highlighted before, it's become a very aggressive audit area from ZATCA perspective. So now we will go for Q&A session. And
Hani, I do have a lot of questions from our viewers. The first one, and I'll pose that to you. It says that if the aggregate value of related party transactions during a financial year exceeds SAR 48 million, in such a situation, transfer pricing compliance is voluntary, like we discussed. What could be the disclosures in the TP documentation in such an event if the entity decides not to adopt TP provisions?
It's nothing will be required or needed, even in the tax declaration itself, as long as a payer he not filled the TP forms. It will come to ZATCA when ZATCA review or audit the tax declaration, the Zakat declaration itself. He knows that it's voluntary, so there is no requirement from the payer. Because of course you are filing your tax declaration along with your financials. So he knows in the related parties shareholder already not exceeded now this 48 million, so there is no required to be followed in such a case.
Perfect. I hope that answers the question, and the reader is fine with that. We have another question, Hani, for you, which says that will these regulations and compliance requirements be applicable only on the Zakat payers with multinational related parties, or even with the ones with domestic related parties?
No, it will cover all related party, irrespective if it's a domestic or international or multinational one.
Perfect. I have another round of around 4-5 questions, Hani. One, it talks about that my group company pays royalty, and it's a UAE headquartered multinational, and the KSA entity pays royalty to the UAE entity, and the KSA deducts a withholding tax. Will a credit of that withholding tax be available to the group company in UAE when the UAE corporate tax comes in?
Yeah, so now we good thing is that we have a tax treaty between UAE and KSA. And one of the provision already introduced in UAE law that for any withholding tax deducted in another country can be claimed in UAE here. There is one condition that the withholding tax claimable amount will not exceed your annual tax liability. If there is a balance, so you can move it as a credit balance, you can file a separate refund claim to FTA or tax authority in UAE to claim the difference between the two amounts. Of course, the document will be required. It will be, we can discuss separately, but there is a form need to be filled. Tax residence certificate will be provided, the agreement, the contract, the proof of payment, all of this document need to be provided or submitted to claim this withholding tax as a credit here in UAE.
Perfect. And Hani, one, another question, and which is very, very relevant to your past experience. I know you've been, part of the Egyptian tax authority. You've seen the other side of how the regulators look at, these intercompany transactions. The question which one of the readers or the viewers really poses, that what has been your experience and how ZATCA has seen whenever there is a management fee being paid by KSA to its overseas group company. And now, or while I know you've touched this briefly during the presentation, but could you just spend 2-3 minutes explaining how the authorities typically look at these arrangements and what are the kind of documentation which is required?
Yeah, so in management fees, we have two aspects here. The first one for transfer pricing and the other one for withholding tax. But we maybe know that, our audience maybe knows that withholding tax on management fees is subject to 20%, which it's big and high percentage, higher percentage in withholding tax regime in KSA. Coming to transfer pricing itself, ZATCA position on reviewing in any related party transaction is they are very, very aggressive. And for management fees, you always request for the proof for charging such a fees from entity to KSA entity. Even they go for, if you are a taxpayer or Zakat in our case, in these new changes, if it comes to showing that such a management fees related to HR, finance, legal team, whatever, they are requesting even for the timesheet or hourly rates that you are following to charge such fees from entity to entity. And what is the salaries they are, this stuff or only they are taken from other entities? What is the cost they are bearing? Of course, we are not saying that ZATCA position or challenging such a management fees, it always come to their favor, but as long as you have a very supported document in place, a proper one, then that can justify why this management fees needed in KS entity, and what is the basis you are following, then you can support your position. As an example, if you are saying here, we are charging management fees to KS entity, just one example, for HR management fees, okay? And in KS entities, you already have the full team of HR staying there and based there. So what is the justification to charging such fees to KS entity? You need, of course, we are, it depends from case to case, business to business, industry to industry, but you need to justify why you are charging extra fees for something that already exists in KS entity, and they can perform internally there. I hope I answered your question on this one.
No, I think that's pretty detailed. And Hani, really your experience of being on the other side with the authorities really helps. And that's how typically the authorities, and I think the short point is that the documentation is the key, the backup is the key. And in terms of not only cost allocations, but also justifying, is there a need for the KSA entity to receive these services or not? Typically, like you said, that a duplication of service should not happen, that you have a HR team, already a full-fledged HR team running in the KSA operations, and you have a HR cost being recharged from your group company into the KSA. That really is a red flag, which the authorities are going to look at the first go. We have another question, which is more on the APA related, and I'll probably, there were actually two questions, and I'll take them together. What has been your experience on the APA program and how successful it is, and what are the typical time frames you've seen on the closure of these APA programs? Now, generally, this is a newer concept typically for the case authorities, but globally, APA is a well-known concept. Group companies, tax authorities do enter into bilateral APAs. Typically, it is a mechanism to really reduce significantly the time and effort of litigation in a particular jurisdiction. Whenever there is a transfer pricing dispute, typically the taxpayer would need to hire lawyers, pay a court fees, get into those disputes, interact with the authorities, and it is more like a post facto analysis whenever there is a litigation in place. But thankfully, in case of an APA, it is more like a forthcoming exercise. You have your documentation being prepared on a real-time basis as and when you're entering into a transaction. Hence, the justification of the arm's length price typically becomes much easier when you enter into an APA program, which is more forward-looking. And hence, the benefits typically of an APA program is far more than having a transfer pricing dispute with the authorities. Typically, we have seen that a unilateral APA generally takes 6 months to a year to really close down, because there are just two authorities. It is more of a regular interaction between the taxpayer and the authorities. That is the time frame which typically a unilateral APA generally takes to conclude. A bilateral and a multilateral APA typically takes more time. A bilateral APA would generally take somewhere around 1.5 to 2 years. And, Hani, if you can correct me if, those are, are way off numbers, but typically, generally based on our experience, we've seen that 1.5 to 2 years is what a bilateral APA would take, and a multilateral typically takes 2 to 2.5 years to really conclude. It really depends upon the proactiveness of the authorities on the other side as well. If they are willing to close on a particular transaction, on a particular transfer pricing dispute, then typically it becomes much faster. If the numbers are of significance, if the transfer pricing dispute is complex, then the authorities are proactive in closing it, and hence, it just speeds up the process. Another question, Hani, and probably, that could be for you, is that how the ZATCA will identify that the other party in UAE is a related party to the Saudi company. And we have another question which is more related to this, which says, can you explain what is the meaning of related parties in the terms of transfer pricing? So, I think the crux of these two questions are, what is a related party typically from a Saudi perspective, and how do they determine, or the authorities determine, that the UAE entity is a related party?
No, and it's already covered by TB guidelines in KSA for determining the related party. That's for if the ownership more than 50%. If you have a connected person like direct person, like you're dealing with your brother or your wife, even as a connected person. If you have a controlled ownership of the other entity, management decision, so it's already identified under many categories under TB guidelines or bylaws in KSA. It's not of course, also one of the other aspects that you will have an audited financials. So based on the audited financial as a trigger one, also when the auditor identifies a related party based on the accounting standard, there is a disclosure or footnote for the related party transaction. So it's already in the financial statement as an easy way to identify the related party. But if it's not there, or it's already some of the transaction not covered under this one, when ZATCA review or have an audit, they can identify also, yeah, you have this controlled decision on this entity. So you will fall under the connected person or related party umbrella on the TB guidelines.
Perfect. We have another question which talks about Pillar 2, Hani, and it really says, what about Pillar 2? Will the Zakat payers get credit of the Zakat tax being paid under Pillar 2? And when do you think it is getting implemented? So I'll take it up, and Hani, you can, you can add. Pillar 2 and the global minimum tax, all of us are aware, was supposed to be implemented from 1st January 23, and the countries, whichever the signatories, and KSA happens to be a signatory to that agreement as well. Typically, a common consensus in terms of the regulations, in terms of the mechanics, has still not been achieved by the members. And accordingly, we are seeing some bit of delay in terms of the global minimum tax being implemented across the globe. There are talks whether 1st January 24 is a reasonable date, or should the globe look at a 1st January 25. Now, it would really depend upon how the authorities interact and how OECD brings in all the stakeholders in terms of getting a consensus. We know for a fact that some of the countries in the east side of the world have started looking at or implementing the Pillar 2 regulations in their domestic TP laws or in their domestic corporate tax law. South Korea, Singapore are few of those which have really started that. When we look at the OECD commentary on Pillar 2, it is very specifically mentioned that any tax paid, and specifically they have a section on Zakat tax, any tax paid under Zakat will be a credit, which will be, and it is a recognized tax which under the OECD Pillar 2 provisions, and hence a corresponding credit of whatever tax has been paid under the Zakat. The taxpayer will be able to get a relief to it in terms of computing the effective tax rate and any top-up tax payouts being made by them. Hani, your views on that?
No, thanks. You already covered very well, so no other addition from my side. But only one that we, because of Pillar 2, there is a regulation should be published or released in each country, which is expected in case A to be published or released by Minister of Finance there. So it will cover all the details of implementation mechanism, but Kabil already covered the main aspect of Pillar 2 and the credit, which covers answer for this question, I'm sure. Thanks, Kabil. Thanks.
Perfect. I think we've run out of questions, and I think it was an interesting discussion, Hani, and I'm sure the viewers would have got a lot of insights in terms of how to approach the new amendments under KSA regulation, and how the Zakat payers now would really need to prepare themselves in terms of getting ready for the transfer pricing compliance, which hits them from 2024. Any parting thoughts, Han, in terms of preparedness, and any last statements, and then we'll close the webinar.
Thanks, Kabil. No, one general one, like we already covered on this webinar from beginning of the discussion. We need to have a very proper documentation process, agreement, contracts in place. So it will support my position when it comes to first phase on ZATCA filing or ZAKA filing, when we file our ZAKA declaration or tax declaration. And when it comes also into any queries from ZATCA, and when it comes also to ZAKA or ZATCA audits, especially ZATCA audits, like we highlighted, they are very aggressive. They are going in very, very deep details of transaction. And you can see even these are requesting from some of taxpayers in Saudi, the market reports that the management prepared to see what is the forecast they have, and it's matching what is he already filed or not. So you can imagine how ZATCA goes now. We need to have a very proper documentation in place. And even does it mean that, see, in general, transfer pricing doesn't mean we need to do something to justify the authorities. We need to do something to support our position, in summary.
Okay. Thank you so much, Hani, and thank you, viewers, for attending. And we'll share the recording with the viewers shortly after this webinar.
Yeah, and of course, please also from the audience science, if you have any other further queries or question, you can send it to us, approach us. We will be happy to connect and discuss with you, of course. And thanks, Kabil, and thanks everyone. It really was a very interesting discussion, and thanks all.
Thank you. Bye-bye.
Thank you. Bye-bye. Bye-bye.